I've been in the mortgage business for over 30 years. I had a large commercial boutique lending firm, mortgage firm for a number of years, sold that, invested in senior housing, and then did 18 or 20 flips myself, have been a hard money lender, and then got into notes. So for a few of you, bear with me, it'll be just a little bit rudimentary to start here, but some people are just getting their feet wet. So I'll try and make it clip along here as quickly as we can. So primarily what I invest in is not non-performing notes, but performing notes. They're designed for people who want to have consistent income over a longer period of time, maybe an investment period of 10 years or so. Invest in them with a self-directed IRA, something of that sort, and sort of do a set it and forget it type of investment. I also invest for my own portfolio and broker non-performing loans. But as David said, a lot of those are getting pretty pricey these days. So I'm not doing as much in that space as I possibly could. We're going to focus primarily on the basis of all sorts of notes. So let's talk about the series. We're going to talk about what notes are, how they're created, how they're bought and sold, what the types of notes, what you can make from them, and how you can build your own practice if that's something you want to do. In this crowd, it sounds like it's something where somebody might want to supplement what they're doing, buy a couple of notes here and there in addition to their day job or anything else. And then through the series, as we get more and more into it, we're going to have lots of examples because there's a lot of different ways to structure notes. There's what I call just note traders, people who will buy a note and sell a note or just invest in one note. And then there are people who just straight broker notes, which do the same, but they can also manipulate them to actually squeeze as much income out of them as they possibly can. So, types of notes, performing. I think we're all familiar with a performing note. Those of us who have a mortgage on our house are making our payments, 30-year mortgage, that is a performing note. Re-performing note. Say Bobby had a house, he was cruising along just fine, had a medical problem, lost his job, whatever, stopped payments, payments restarted. He's been bouncing along, now he's back on his feet. That's a re-performing note. Non-performing note, no payments are being made for whatever reason, medical problems, lost a job, recession, anything, but that's a non-performing note. And then these aren't types of notes, but I just wanted to mention that a lot of people create notes through buying products like David and John have, and they buy REO, maybe renovate it, flip it. Typical flipper who's creating notes is buying a house for 25 or 50. Let's say he's buying it for 50. He's putting 25 in it. He's selling it for 150, and then he resells it fully loaded, which means that he's selling it leased up at maybe a 12 cap or something like that to an investor who's putting $75,000 down. So he's gotten his money out and he's carried back a note. One of the reasons he would want to carry back a note is obviously to avoid ordinary tax rates and build long-term capital income and for himself. So that's a good reason why people do this. So how are notes created? A little bit of backdrop here. It used to be that notes were primarily created by sellers. Bobby sells a house, somebody can't qualify for a mortgage for a number of different reasons, and he carries back a mortgage. I think we're all probably pretty familiar with that. However, most of the notes that are created in today's market came out of the recession. So as most of you probably know, Fannie Mae and Freddie Mac bought or had to take back somewhere north of $30 billion worth of mortgage notes. They, because of the recession, they packaged those and resold them to hedge funds and different groups like that. Banks also create non-performing notes and REO. We've all heard about going to a different bank and buying something. Flippers create notes like I just mentioned. And then there's typical seller carryback. So let's talk a little bit about institutional notes and what I just alluded to. The large groups, Fannie Mae, Freddie Mac, took back over $30 billion worth of notes and sold them to groups like Goldman Sachs. Goldman Sachs is still buying these notes. The recession officially ended in what, 2010? That's my guess. I don't know what number anybody else is using. Fannie Mae just sold to Goldman $1.25 billion worth of these notes that were defaulted and in various shapes. So this is still trickling down. Also, Mortgage Bankers Association estimates that 30% of the homes that are financed today nationwide are still underwater. Now, that's not going to be true here in California or some of the places where we've got so much appreciation, but when you go into the Midwest and places like that, you've still got people who have got $300,000 mortgages on $100,000 houses. And the people haven't moved because, quite frankly, in a lot of cases, they're making a $300 a month mortgage payment, and they know if they move, they would A, lose their equity, and B, rents in that market are probably $1,000 a month. So, oh my gosh, why would they move and increase their carrying costs? So these groups like Goldman buy them and they sell them to mid-size hedge funds. They'll sell them at maybe $100 million groupings, which in turn will take some of them, work some of them out, talk to various people. Maybe if Jackie owns a house, we say, hey Jackie, you haven't been paying, are you going to pay? And you go, oh yeah, I guess I should do that. And he very nicely starts to make his payments, or not, and at which case they proceed to foreclosure and send him on his way. They'll go in, work some of those houses out, renovate them, resell them to somebody like John. John lives in it with his wife for 3 years, and then they can sell it as a performing loan, so at a very nice profit. And just as a total aside, if you look at the profits that groups like Goldman and even the mid-size hedge funds are making on these, it's pretty amazing. A lot of these groups are making 75 to 100% a year annually as they're holding these things, and they're still passing on good deals to people down the river. So they will sell a lot of them, and they will keep some of them for themselves. Again, they are doing what I just mentioned. They will sell those to smaller funds, which will sell off the one-off assets to somebody like me. Maybe they'll sell me 20 at a time. Maybe they'll sell me 2 or 3 at a time. Just a second. And they'll sell them as non-performing, re-performing, or they'll keep some of them ourselves. Yes?
Why do these original lenders not just go do like an REO and just list it on the MLS? And why sell it such that a company like Goldman can make money and then their downstream has enough equity to make money such that their downstream also, like, seems like the bank, like most properties the banks propose, they just sell the market. Why do they not do that with these?
Well, a lot of the original banks that you were talking about were nuked. Their balance sheets were so upside down, the FDIC came in and shut them down. And so they took good performing properties and non-performing properties, and they sold them all to Fannie Mae. They had to take them all back because Fannie Mae was a secondary market. So those institutions are no longer around to even make the loans. Now, in today's market, which is what you were referring to, they can do that. They can sell a lot of them off, and they do that. But I haven't seen any statistics on it, but I think it's close to 25% of the banks that were in existence pre-recession are totally wiped out post-recession. So they're not there to make the loans. That's the reason why. To continue on, we've got banks that are creating non-performing notes or have non-performing notes and REO. Flippers are creating notes, and then we have seller carryback. So why are seller carryback notes created? Well, in a lot of cases, people can't get mortgages on these smaller notes. Now, my focus is smaller notes, primarily in the $30,000 to $80,000 category. We'll talk a little bit more about that in just a second, and I'll show you why that's where I focus and where I think you will want to focus. Post-recession, Congress passed what's called Dodd-Frank rules, and the Dodd-Frank rules stopped lenders from making really high yields or high fees on loans. So for instance, on any loan less than $60,000, they capped them at 5%. Well, you'd say, geez, 5% on $60,000, 5% is a lot of money, right? Why would you want to pay 5 points? But that's only $3,000, and the bank has to pay its originator, pay its for the appraisal, pay all of its servicing fees and everything like that up front, its onboarding fees, out of $3,000, and they say, nuts, I'm not going to do this, it's just not worth my while, it's not efficient. Plus, I don't get very much servicing out of it. So a lot of smaller banks won't even look at these loans. So what a lot of people do is they have to go back to their seller, and their seller makes them a loan. A lot of these borrowers are non-citizens, especially in the areas like Michigan, Wisconsin, where you guys like to buy right now. A lot of those people have come down from Canada. They're not citizens, they're here legally. They've got what's called an ETN, so they can live here and work here, but they can't qualify for a mortgage. So they need seller carryback financing. In some cases, since this is primarily worker housing, these people just don't have a lot of credit. Mom is a school teacher and dad is working for John Deere or something like that. Their combined income is $100,000, and so they just don't use a lot of credit. They've got one credit card and maybe their home loan, and they've paid off their car, and so they've got what's called a thin credit. What lenders like to see is a full credit picture. They want you to see, even though you think it's counterintuitive, they want to see that you've got a credit line with a couple of major banks, an auto loan, a house loan, maybe one or two Macy's and department store type of loans, and a Home Depot account. So that's a full credit picture. So what that says to them is oh, John's a good guy, he's got a good credit picture, I'll give him a higher rating because he's using more credit. A lot of these people don't have that. They've got a 650 credit score just because they don't use it very much. Or in some cases, they've just got a blemish. Maybe they went through the recession, they were paying fine before then, they lost their jobs, they've been paying fine since then, but with a 7-year requirement on these lending requirements, they can't get a loan because they're not beyond the 7-year mark. So they're perfectly good borrowers, but they can't qualify for a loan. So that's why you get a lot of seller carryback. Why are they sold? Well, the institutions raised money to make these loans, and at some point they've got to close their fund. They did a 5-year, 7-year, 10-year fund, whatever it was. They need to close them out, so they've got to release those loans onto the market. The banks need to clean up their balance sheets. To meet federal requirements, they can only have so many bad loans or good loans on their balance sheet, and they've got to have certain allocations in geographic areas. So this is part of their cleaning. Yes?
The screen.
Uh-oh, thank you.
What is a seller carryback note?
I'm sorry?
What is a seller carryback?
So the question is, what is a seller carryback note? So if, I'll use Bobby again because he's a good pigeon. He's got a house to sell, and he wants to sell it to Carla here. And Carla goes out and he says, well, I'll sell you this house for $100,000. And Carla says, good, I'll put down $10,000 and I'll go get a loan. Carla runs around, tries to find a loan, and for whatever reason, she can't get a loan. So Bobby says, well, I'll act as the bank, and I'll make your mortgage. So I will lend you the $90,000. So he draws up a note, that's a seller carryback note, and Carla makes her payments to him. He is the bank.
He gets the interest.
He gets the interest, right. So when you buy a note, that's what you're buying. You're buying that, whatever the unpaid balance is on that $90,000 note, and then you get the interest. Individuals have a ton of reasons for wanting to sell these. Anywhere from, gee, I have medical problems, to, oh, I want to take a vacation, or I want to put my kids through college, or divorce is a huge one. Believe it or not, a lot of real estate in the United States is sold due to divorce, just straight out divorce. So those are the reasons. Let's talk a little bit about the discounting of notes, and I said earlier why I invest in the lower margin. So if we look at the top of the pyramid that I have here, that's $650,000 and above. Here in the Bay Area, we don't think of anything of a $650,000 mortgage. It's pretty common, right? But nationwide, that is extremely high. Most mortgages are down around the $80,000 to $120,000 category when you look at national statistics. So those mortgages, when they're traded, are very thin margins, very low rates, and very high equity. I looked at one about 6 months ago, I guess, just outside of Beverly Hills. It was an $800,000 mortgage. It would be very difficult to sell somebody an $800,000 mortgage because even if you carved it up, Not a lot of people can, write a check for, say, $200,000. But that note was made at 6%. I could have bought it at a 7% yield at a discount, and I could have sold it to John at 5%, for which he would say, I don't think so. That's just not exciting. So the margins are very thin at the top end of the market. As you go down into the next category, which is 350 to 650, the margins get a little bit better, but still they're not great, and so on. You can see the various categories you've got there. The Best Buy, the highest margins are on the smallest properties. So it's a little bit like going to Costco. If you get a big purchase and you buy 48 rolls of TP, you get a better price. When you get a smaller, you go to Best Buy, or not Best Buy, where do you buy? I'm sorry, CVS. You go to CVS or wherever where you buy maybe a pack of 4 rolls of TP. You're paying more for it. So a lot of these mortgages that you see in the lower end of the market are anywhere from 9 to 12%. And people are willing to accept them because they can't get credit anyplace else, number one. But number two, they sort of take these mortgages like we all buy cars. We might buy, Carla would go into a dealership and she'd say, well, I want to buy a car. The salesman might say, well, it's $70,000. And she goes, oh, that's too much. But he says, well, the payments are $200 a month. She goes, oh, I can afford that, knowing that she's never going to pay that full $70,000. And the same thing is true for people in this price bracket. Quite often they can't fathom that they could pay off a $60,000 or $70,000 mortgage, but at $400 a month, that's something they can handle. And so they'll go ahead and take that rate. So how do you buy them? A lot of people buy them through their self-directed IRAs, because you can get whatever rate you get is tax exempt, and you don't pay it until you cash it in at the end. If you buy it through a Roth or self-directed IRA, you never pay tax on it. You pay it when your money goes into the account, but thereafter you don't pay any taxes on it. Or you can just buy them with cash. Let's say you don't have that much money in a Roth, you haven't moved money out of a 401k or anything like that, so you just buy it with cash, and that's fine. One thing I always want to tell people about is that these do not work with 1031 exchanges. I've had a number of people come up and say, oh, I want to sell out of duplex and I've got $400,000, I want to move out of it, can I buy some notes? The answer is no. This is not, even though it's real estate, does not qualify as like-kind property, and so it does not qualify for a 1031. Where do you buy them? You can buy them from people like me who are in the market all day long. You can buy them from different exchanges, groups like FINAC and Notes Direct. You can sign up on their website and do the analysis and find them yourself. You can always go to banks. We know about buying non-performing loans from them. You can create them, just like we talked about before, where flippers or REO agents can make them. Ways to do business. If you want, sir.
Which exchange name did you mention? That exchange?
Notes Direct. Yeah, Notes Direct is in Texas. And just go put in notesdirect.com and they'll come up on the website. Another one's called FINAC. It's FINAC. And just put that in, and they're another exchange.
Was that where you purchased them?
Yeah, you can purchase them from them. You're not going to get quite as good a deal as you might if you came to an individual or somebody who's selling them directly. That's the bad news. The good news is that especially if you're starting out, those are somewhat scrubbed. It's really quite analogous to what David and John are doing. They don't want to sit around and go through all the stuff that it takes to buy their tax liens. Well, if you go to Notes Direct, they've already scrubbed those a little bit. So you know that you're going to have good, clean title. You know your paperwork's going to be in order. So it's more for you to just analyze it and say, gee, is this a deal I want? As opposed to, am I missing all this paperwork? Is there some bug here I'm not noticing or anything like that? So there are advantages to going to an exchange. Yes, sir.
When I think about exit strategy as an investor, if I'm buying a note or I'm funding and doing a seller carryback loan, either I have to wait, let's say 30 years for them to pay off the note, or 2, they have to refinance and somehow I need to get that money back. But if they can't get a loan from an institutional vendor and I'm the one that's giving them the money, and the risk there is on me to hope that they can refinance in 10 years, otherwise I have to hold it for 30 years.
No. No, so the question was, is do you have to buy, if a note's got, first of all, if it's a 30-year note, I would always wait until it's seasoned. So there is payments that have been made, so at least 3 years. So you might have a 27-year note that's left. And you do that because you want to know that you have a borrower that's going to pay. Now, we haven't talked about partials. We're not going to talk about partials tonight, but if you said there's 27 years left, I really only want to be in this for, say, 10 years, I can sell you the first 10 years of that mortgage. I can sell you the first 5 years of that mortgage, as a matter of fact. Any period that you want. If you bought 10 years of the mortgage and you wanted to get out, I could also buy it back from you. I wouldn't guarantee, but I'm in this market all the time. There is liquidity in this market. So if you said, oh gee, I've seen this other investment that I really want to make, and therefore I'm going to, I want to cash out. I can't guarantee it, but there's a very good chance that I could buy it and or I could sell it to somebody else for you. So there's liquidity in the market.
Onus is on the person who holds the note to, in 10 years' time, to get another loan from someone else if you only put 10 years down as a payback period.
Well, if you do partial, you're automatically out. So at the end of that 10 years, you will have been amortized out completely. You will have gotten your rate of return, whatever that is, and so you're automatically out. You've been paid off. And that's another thing that's nice about these notes is that if you make an investment in the stock market, say you invest $10,000, at the end of the period, hopefully you will have gotten your appreciation, whatever that is, and you get all your principal. Well, these are amortizing loans. So in year 5, your principal balance has been paid down a certain amount. So your risk is less, even though you're getting the same payment back. So that's something that mitigates this in terms of your investment. Ways to do business continued. So you can just buy and hold these. So my strategy is I'm brokering some notes. I'm doing what's called partials, but I'm also just buying some notes for myself, for my passive income. I can buy them and hold them and live off of that income very nicely. I can buy non-performing notes and hold them. Once I get them to be performing, again, I'm buying them at a better margin, so I just make more money on a monthly basis. I could create my own notes, or you can create your own notes if you want to. If you're flipping, you can sell something and just get a down payment to cover what you've got in the deal and carry back a note. And you can also help other people create notes and help other people out of problem situations. I've had several people come to me and they say, oh gee, I've got this apartment project, I really want to get out of it, I'm tired of doing toilets and tenants and turnover, can you help me out, but I'd like to keep my income. Sure, you can sell it. Sell it to David and he'll take on that burden and you carry back a note for him and you collect the payments. Very simple. He may not want to do that, but you can find buyers that will. How do you do the analysis? Analysis on these numerically is pretty easy. You can do it with a little 10 HP B2. You can download it onto your computer or your phone, or you can buy one. You're going to use these four calculations for the most part of it. N is for the number of years, the interest rate, loan amount, and monthly payments. If we all think back to our algebra classes, which may have been many, many years ago, I admit, if you have 4 criteria, you can change any of those and solve for one. And in this case, what you'd be doing is you would be changing the yield and solving for the loan amount. And I'm going to show you how to do that in just a second. And I'm going pretty fast here because it's getting late in the evening, but we'll go over this much more in depth in later months. So let's take a little example. This is a little house in Anderson, Indiana. I look at a lot of these houses in these small towns, and believe it or not, this is a $50,000, $60,000 house. It's 3 bedrooms, 2 baths, and it's got a house or a street that's got sycamore trees all down the side. And you go, I'd like to live there. I mean, especially for $50,000 or $60,000, I'd like to live there. Now, I don't want to put up with Indiana snowstorms and that kind of thing. That's another. With my California eyes, that's another matter. So this particular note, when I bought it, and I've had this for a couple years, had a 9.9% rate on it. It was a 30-year mortgage, and I should say that we do everything here in months as opposed to years. The remaining term is 273 months, and the original loan amount was $39,500. So that means he probably bought this house. I've got it at someplace for $41,000 or something like that. So he put a couple $1,000s down. The unpaid balance on it right now is $37,241 and a few cents. So those are the numbers I just quoted you. So I said, well, all right, I'd like to buy this to the seller, and I told him I wanted a 14% yield. We were able to work that out. So I paid him $28,000, $28,220 for that note that had an unpaid balance of $37,241. Now, why would he accept that? He needed the money for medical reasons or whatever. This happens every day, so that's it's just the market. So what would I do? If I were to broker this, how would I make money on it? Well, I'd say, all right, fine. Here are the characteristics, as you see before you there, of what it is at a 14% yield. I might sell it to Padma at a 10% yield for $36,000. And again, these are just changing those 4 criteria on your calculator. And that sale price would be $36,966. Yes, sir?
And if somebody's paying this rather high rate of interest, right? So I'm just trying to get my head around who's paying this high rate of interest.
Well,
The homeowner?
keep in mind, the 9.9% is the original. And the payment in this case was, I can't remember what the payment was. Let's see. The payments don't change to the borrowers. So what you're changing is just the loan amount.
Right.
Right.
But the original homeowner would be paying 9.9%.
Right. Because remember I said they're looking at these where A, they can't get a loan anyplace else, and B, they usually say, am I looking at total amount or am I looking at monthly payment? And in this case, the monthly payment's not that much. He could pay it just fine. So he said, okay, great, I'll take that. So I've sold this for $36,900 roughly. So where does the profit come in? Well, I bought it for $28,220. I'm selling it for $36,996, and I would have made $8,746 on this sale. That's just a typical example, simple example of how somebody makes money on brokering a performing note. Let's go to a non-performing note. This was a little house in Rockford, Illinois. Bobby knows Rockford very well. Actually, I'm going to probably be there in just a couple weeks. Nice little market outside of Chicago. This is what I bought when I bought this house. I bought it as a sub-performing note. So as you can see, it's a nice little house, little big wheel in the front there with the kids. It's a 3-bedroom, 1 bath. And the borrower had sort of missed some payments here and there, but it was okay. I bought it at a little over an 18% yield, so I took a risk on it. So here's what I bought. It had an 8.85% interest rate on it. It was fairly short term, so I was going to keep this in my portfolio for myself. I wasn't going to sell it. Had a good return on it, and I thought, hey, I can live with 18% for a while. Original loan amount was $16,300. And the unpaid balance was $12,124, as you can see. There were some back taxes on it. He hadn't paid his taxes, surprise, surprise. So I had to pay those. So my all-in on this was $9,997. Yeah, call it $10,000. Okay, and the monthly payments that he was paying to me was right about $265 a month. So he defaulted. In truth, he started to pay less and less, and I found out about 5 months later, after I'd sent him notice of default and everything, that the guy died. And so there was actually nobody even to send payments to, and he didn't have any heirs or anything like that. Don't know what happened to the big wheel and why it was there, but the fellow passed away. We had to go find his mother, and she eventually signed off all the papers and signed the house back over to me, and I got it. Needless to say, it was in a worse state when I got it than when I bought it. Not terrible, but I had to put about $10,000 on it. The foreclosure costs were only $200. I bought this under what's called a land contract rather than a mortgage and a deed. We'll go into those later. It works the same way. It's just a different mechanism for owning a house. I had to put right about $10,000 into it, and I'm just actually coming up to selling this. It's going to be about $1,000 to sell this. You don't do this through a realtor in an MLS. You put a sign out in front that says "House for Sale." To buyer who will put down a large down payment, and you let it sit, and you put it on Craigslist, and you advertise it at some of the RIA meetings, and that's how you sell it. Or you do what I mentioned before, which is you load it up with a tenant and sell it to some California investor or somebody else fully leased. Right? So I had $21,197 in it, right? So I am selling it for $40,000. The down payment I'm getting is $20,000. So somebody tell me, how much money do I have left in this deal? Very good. Believe it or not, some people don't figure that out. So new loan amount's $20,000. I made a loan for 84 months, 8%, and my payment that I'm receiving is $311 per month. Well, I've only got $1,100 in it. I'm getting $300 back, so you can tell I'm going to be paid out quite quickly. It's not a lot of money, but in this, this was a small loan to start with, so it's decent, and I'll take it.
Who's originating and who's servicing?
Okay, so who's originating and who's servicing? I'm originating it because it's my house. There are about a half dozen mortgage servicers who will service these loans, and that's all they do. They service private mortgages. I would never service myself. Some people do. To me, you've got to meet all sorts of Dodd-Frank requirements and everything like that, and it's just not worth it. So this servicer I use charges $18 a month, and I pay that to them gladly because they send out all the notifications and everything else. So that's it for this evening. If you have any questions, I'll be happy to answer them. But it's the start of our series.